Getty, an Italian M5S party support wears a mask. The eurozone is set for a massive make-or-break day, with the Italian elections still too close to call and the results of a ballot of Social Democrat Party members on a coalition deal with Chancellor Angela Merkel's Conservatives. The worst-case scenario for the eurozone is a future without Angela Merkel and Silvio Berlusconi. Potentially the carpet could be pulled out from beneath Merkel in her hopes for a fourth term in office if the ballot doesn't go her way, while in Italy former Prime Minister Silvio Berlusconi faces the real threat of losing out to a centre-right anti-EU coalition. David Zahn, head of European Fixed Income at Franklin Templeton, says that there are two probable outcomes for the Italian election. He told Express.co.uk that the most likely scenario is that no party reaches a majority and Italy operates with a technocratic government or a grand coalition. In this scenario, Mr. Zahn doesn't expect to see a huge impact for global markets. However, he argues that the other potential scenario of a centre-right coalition securing a majority government could potentially bring some shock to the market. He said, while the centre-right coalition have not declared any interest in leaving the European Union, it is known that they have expressed a desire to increase fiscal spending against Brussels' wishes, and are generally in favour of more local powers. A key consideration for the UK is that if the centre-right coalition were to come to power, it could be argued they might take a softer approach to Brexit given the somewhat anti-Brussels stance. We think the market may be underestimating the risks here, especially given that the euro's pro-cyclical in portfolio inflow-driven rally could run out of steam if political risks stay slightly elevated in the near term in Group if, and it's still a big if, Italian voters carried the centre-right to victory. Fears would return to the market of a euro breakup, further widening the gap between Italian and German bond yields. Ing told Reuters that investors are yet to understand the scale of the potential uncertainty here. The Dutch financial giant said, in a note, "We think the market may be underestimating the risks here, especially given that the euro's pro-cyclical in portfolio inflow-driven rally could run out of steam if political risks stay slightly elevated in the near term." Analysts pointed to weekly futures data that showed net long positions in the euro had fallen for a third consecutive week. European Central Bank President Mario Draghi's appearance in the European Parliament on Monday and eurozone inflation data due later this week also add to a nervous outlook for euro trading. Sunday, February 25, 2018. Protest against the meeting of Italian far-right movement CasaPound in Milan. But will whoever wins the election be ready to tackle Italy's massive debt pile? According to Reuters, whatever Italy's next government looks like, the chances that it will push through long-term structural reforms to improve Italy's economic performance or to tackle the country's debt pile are low. At 132% of GDP, Italy has the European Union's worst debt ratio after Greece. In fact, election pledges could worsen the situation. Bank of Italy Governor Ignazio Visco has cautioned that parties' pledges to slash taxes and hike spending could prove counterproductive, since the problem of high debt cannot be sidestepped. That could increasingly bring investors to view Italy as the eurozone's weak link, making Italian assets vulnerable at times of market uncertainty or during the withdrawal of European Central Bank stimulus.